Hey guys, for more like this, don't forget to hit the subscribe, the like button, and the notification bell. Okay, everybody, it's Kevin Wadsworth and Patrick Karim, NorthStarBadCharts.com, and look who we've got with us today. It's the legend himself, Henrik Zeberg. Welcome to the show, Henry. How are you doing?
Thank you very much. I'm feeling fantastic. Feeling fantastic here.
And Henrik, I'm pretty sure that some of your views are quite polarizing. I know you've got some very strong views across the markets and precious metals and plenty of other things. So we'll get into that very shortly. But do you want to just give a little bit of background yourself about what got you interested in technical analysis? I know you've been doing it for quite a long time now.
Sure. So really, I think first of all, I'm educated. I have a background from the University of Copenhagen, where I have a master's degree in economics, national economics. And I was, but what happened was during the financial crisis, I was probably like many others taken by surprise of what happened, and also kind of got caught with my in a bad with bad positions and within the real estate market. And I kind of, wondered what was it that was going on that nobody really foresaw or had, seen to this extent. And could we really just get overwhelmed by something that just kind of came out of the blue? And what I then I started on a journey which has now lasted for the last 15, 16 years, where I may have dived into this in another way than what you normally would see people do. I think I've been studying the structures of things, as I discovered that the ones that were actually able to foresee the financial crisis were people that also looked at it from a more structural perspective than just having, a normal bank analyst kind of approach to things. So when I started to do that, I familiarized myself with a certain, a range of techniques, and I then started to build my model, which is based on Elliott wave understanding, which is really psychology, market psychology, and then building it in a way where you take a very big perspective and then have a lot of charts and then play into to each other, so that it's not just about one market, it's about all the markets, it's about all the asset classes, and so on and so forth. And you cannot just predict something if you just have one chart. I mean, I always dismiss that immediately. So if somebody shows me an Elliott wave count and they do it on a daily chart or whatever, and I just say you can't use that for anything, because you need to have an understanding of where we are in the bigger perspective. So this, and then also pairing it up with some of the things we just discussed here just before the show here with the Kondratiev cycles and the likes, and that kind of gave an understanding of where is it that we are in terms of a macroeconomic environment, and where are we heading, and at least that's what I think is paying out right now. I think we've had some ideas of where the market is heading, and it's not been just the normal consensus way that we've been pointing to.
Wow. Well, I think it's so weird because the stuff you're saying, it resonates a lot. We love doing weight of evidence, big picture, bigger time frames. Yeah, exactly. Somebody shows me a daily chart. Somebody's telling Bitcoin to the moon, but I'll zoom out. Maybe on a longer time frame, it's going down. Yeah. So I don't know. We might differ on where we're heading next, but at least your framework encompasses the bigger picture, which I think is crucial. You never want to fight the bigger trends, because instead of tailwinds, you'll have headwinds. You could have rug pulls if you're trying to play counter trend rallies. So that's that's pretty cool to hear that. And I don't know. So maybe we could start how you want to do it there. The Kondratiev waves, is that how you pronounce it?
Sorry, the what?
The Kondratiev cycle, I think.
Yes, I'd love to hear about that just a little bit.
Yes, Kondratiev cycle. Yes, yeah. So basically, I know it's instead of going into a lot of details of that, because it's not as precise science. But what I see is that if we look over the very long perspective, we will see as human beings that we go through the same kind of emotions. We think we've become so clever, and then all of a sudden we could become over enthusiastic about something. Let's have the railroad coming out in the mid 1800s, and then you had people thinking, okay, now we can travel from coast to coast in the US. We are so technological advanced. And then a lot of, railroad companies and the likes were, coming up, and a lot of, fraud and also speculation around that. And then you saw that bubble collapse. and it developed into something of a crisis in the 80s, 16s and 70s, or 1870s. So you have, certain setups or ways of where we think as and we act as human beings that does that we, that simply makes us kind of get into the same kind of setup all the time, and that's why we tend to do the same. That's why we say history rhymes, or it repeats itself. It is simply because we act in the same manner, because we think we have become wiser, and then we do exactly what we did, previously. So Kondratiev, he was this unfortunate economist that I think was put into a gulag camp by Stalin, because he was sent out to predict why market economy would not thrive, and why you would need socialism. And then he came back and actually said, well, it's not really what I see, and he actually had made this model of where we go through an autumn, a spring, a summer, and a winter in economic terms, and each of those have very distinct characteristics in terms of where and what to invest in. And we are currently, as I see it, in the Kondratiev winter, which is unfortunately the worst phase. But if you compare it to what we have had in terms of Kondratiev's winters, then it's like the 1930s and 40s. It's the 1870s, which were this also, huge depression also actually in the US. It's the 1800s. It's the so it's the big times where you have war. It's where you have some of the big economic turmoils. That's unfortunately the period that we're in right now.
It's interesting. It's interesting you should say that, actually, because Pat and I were talking just before we came on air with you to look at the stock markets, and one of the charts that we've been following really closely lately is the stock market versus inflation, using PPI as a proxy for inflation. And I know there's a big dichotomy of opinion at the moment with regards to whether we see a significant, if you want to call it, a melt up in the stock markets, the S&P, NASDAQ and Dow Jones and so on, or whether we have more or less reached a point where a sort of almost gravity takes over and the stock markets are pulled down. You referenced the 1930s there, of course, and there have been 3 occasions so far since, well, in the last 100 years, that the stock market has broken down versus inflation. The first of those was the early 1930s, as you mentioned, and then the 1970s, and then around about 2000. So there have been 3 periods where we saw major bear markets in the stocks, and in fact, on occasions, taken over 20 years to recover back to those inflation-adjusted highs. So, and even in nominal terms, taking sort of something of the order of 10 to 15 years to recover those nominal highs. So just looking at that sort of SPX to inflation chart, that ratio chart, it's made us an important breakdown below a support line, and is really hanging by its fingernails onto a secondary support line, which is pretty tenuous, because it's based on a candle wick on the chart, but it is just hanging on by its fingernails. So I don't feel in a position yet to completely declare myself that the evidence is 100% in favour of a stock market breaking down and melting down, but it does appear to me, at least, as though the probabilities have somewhat increased on that. You may have a different view. I just wondered what your view was on the stock market and the dynamics playing out in particularly the US stock markets at the moment.
Yeah, and before you answer, Henrik, before I forget, was the 2000s a winter? Oh man, I'm so horrible. My native language is French.
Yeah, fine.
Was that a winter? The 2000 meltdown, a Kondratiev winter?
I'm not. There is, this is again also where it's not exact science. So I think it's a little difficult to say, but it's definitely the 2007, and what we have now is part of the winter. 2000 could have been part of the autumn. I'm not entirely sure, but normally I would have. And if you look back in my tweets, I would have said it's part of the winter also. So not entirely sure about that one. But coming back to your point on meltdown or crash here, I think it's about understanding, first of all, where before you have a crash, you need to have an economy that is deteriorating. And we have an economy that is deteriorating, but you need to have an economy that is deteriorating enough to facilitate a crash. The crash or the decline we have had since let's say January of 22 until October of 22 has not been a bear market. It's been a bear market because it was below 20%. So people will say, yeah, that's the definition of it. But we did not have a recession. And that's very, very important. It's very important because you do not have the negative going spiral in terms of where the economy is heading, and it's not biting in on itself and getting worse and worse. You had it because inflation was moving up and it's becoming a little too hot, which is not good for stocks because then it starts to bite in on the consumers, and then it eventually could bite in on consumption and on GDP growth then. And that is what we have seen. And that's actually the economy running too hot. It's not the economy melting down like what it was in 2007 and 8. The economy was melting down there. And if you didn't put a stop to it, you would see it could bite in on itself and the deflationary spiral could go on. That's not what we have now, or what we've seen. We have actually seen the opposite. We've seen it where it could spin out of control because you could have this, that people get, oh, this is exciting, well, let's, start, inflation is in the system. I need to, we saw it with crypto and everything else, and also with the, the kind of speculation we had in. So people then saying, okay, so what is that we've seen? Well, that's where it's important to get back to the real economy. And the real economy is defined by especially leading, lagging, coincident indicators. And if you look at those, the coincident indicators, which tells us when we are in a recession, have been nowhere near recession levels. Nowhere near. We have NFPs, we have initial claims, we have all of that are far, far away from what we would see during a recession. And we are even at today, and the initial claims are out today, way, way below what should be if we were in a recession. We see also that yes, we do see that the leading indicators have been plummeting. And that tells us, and that tells me in my model, that the recession is coming. And it's 100% likelihood in terms of what I see that the recession is coming. And I foresee a very big meltdown in stock markets.
So is there a dynamic at play here which is important? And I'll just try and explain what I've sort of homed in on over the last 3 or 4 years, and I'm sure you've noticed as well. During the 1970s, the trend of interest rates and bond yields, US 10-year yield, for example, was up. So through the 1960s and 70s, there was a path that the yields and interest rates took, which was supported by a support line rising up. And then for 40 years, from approximately 1980 onwards, we saw a descending channel with the 10-year yields and interest rates falling. Now, my suggestion, my thesis is that the reason rates and yields have been contained below a breakout resistance line for 40 years is because in the United States, of course, we've seen ever increasing levels of debt, both funded and unfunded liabilities in the United States. And we're talking well over 30 trillion as the headline figure, but of course the unfunded liabilities are much, much higher than that. So what I'm saying is that over a period of 40 years, in order to kick the can down the road, for want of a better expression, we've seen yields and rates dropping so that the debt burden can rise. So debt burden has risen, but that's been contained by keeping the debt repayments down through very low yields and interest rates. But relatively recently, in the last couple of years, we've seen a breakout of that resistance line, and we now see 10-year yields moving up beyond sort of 3, 4, and towards conceivably 5%. And this breakout, this technical chart breakout, to me at least, is a new dynamic. It's what sometimes I suppose referred to as a paradigm shift. And you talk about the conjunctive cycle. I've probably got the pronunciation wrong, but forgive me.
No worries.
And I just wonder if that breakout of the yields is one of the indicating factors or symptoms, or one of the giveaways that this winter period is kind of upon us, because it does seem to indicate that we are in a new paradigm here, where yields are rising, interest rates are rising, albeit not in a straight line, and that will, in time, because inflation is becoming somewhat embedded, and certainly here in the UK, very much embedded. We're seeing rising pay demands up into sort of 7, 8, 9% now, and into double figures in many cases. as well as the inflation rate being 10% plus. So inflation is becoming rather embedded, and even if it were to fall back to sort of 5-6%, it's still very problematic. And looking back at the 1970s, it came in a series of waves. Inflation wasn't in a straight line, it was a series of waves. So I just wonder if all of that put together, what's happened with the yields and the rates, might start to make you begin to have the view that we're getting closer to that sort of point where this all begins to break down quite badly. In fact, are we going to ever achieve new highs, new nominal highs on the stock market, for example?
Okay, let me just start out by the conclusion then. First of all, I think yields are going to all-time lows.
Okay.
I do see this, everybody draws this trend line, and there is a trend line, there is a shift coming. But we also know that what we're talking about here, and you were just alluding to it, also saying it is a 40-year kind of trend. So it's back from when Volcker killed inflation and until today. That's 40 years. And even a little more than that, for 42 years almost. And of course, it's not something that's going to change just overnight, or even over the duration of 1 or 2 years. What we are going to see is that we're going to see, and if you look at all my charts, we are going to see a secular bottom in yields coming at some point. But it's not here yet. And the reason I'm saying is because what we're seeing right now, everybody speaks of the deterioration in the economy, but they fail to talk about what that means in terms of yields. Because they kind of say, okay, we see yields are moving up, and then we're saying, yeah, but that means that we now kind of see that inflation gets embedded, and that's why we're going to have the crisis. What I say, and that's also back to what I said earlier on in 2007, and what you see when you have deflationary busts, is that rates are coming down strongly. And if you look at some of the devastation in the housing market, and you look at some of the charts that you have there, and I actually got a chart right here. Let me just see if I can find it. Let me just, hang on for a second. Can I share my screen here?
Yes.
I think you can, yes. Yeah, you should be able to share it. Yeah.
Let me just do that then. So if you look at the NAHB housing market index, and you look at how that actually lead the bond yields, the 10-year, year on year, we have the setup for a massive decline in yields, and this has not played through yet. The thing is, people are putting things together and saying, yeah, we see this with yields, and now we see this with the deterioration. But we have to understand that there is a time lag to that. And this is back to my next chart. And this is about leading, coincident, and lagging indicators. What we see right now is that the leading indicators, which is housing permits, which is also M2, and which is the stock market itself, has plummeted below what I call the equilibrium line. It'll go too far to talk about but that's part of the model. But that's been plummeting below that. Every time it does that on a quarterly level, we get a recession, the signal. The recession is not coming immediately. That will come 2 or 3 quarters down the road, but it's going to come. And I say it's coming in Q3 this year. But what it also means is that this leads the coincident indicators, which is, for instance, initial claims, it's unemployment, it is GDP and the like, and that will slowly be pulled down with it. So the leading indicators will pull us down into the contraction phase. But right now, the coincident indicator, the real economy, is above water here and actually doing okay. And what we look at when it comes to rates, they are lagging indicators. And that means that they will be pulled down much, much later on. So what we see right now is that the leading indicators, which people are confused with, we see that they are really negative, and that's why we should have a recession now. And then they can't understand why it's not there right now. It's because it is, a process that is developing. So these will first be pulled into the negative territory. Then you'll see the coincidence slowly deteriorating, but that could take half a year, 9 months even, from when they turn into negative. And then you'll see rates coming on later. So I do not bind on the premise that we are in a situation where the whole thing has shifted. Yes, I do that trend line. I see that trend line break. But there are so many trend line breaks out there. And, normally what we see, I do think there is a shift coming to it. There is an economic regime shift coming, but it's not coming just now. I think there's another low coming in yields because the contraction that we see in leading indicators is much bigger than what we saw during the financial crisis. So a massive contraction is actually coming at this point, and we haven't seen that yet. And what you see now in terms of rates, is what we saw in terms of the economy 6 months ago. So that's why we need to see that roll over into that next cycle, and that's where I think people are getting confused, because the rates kind of say one thing and the leading indicators tells us something else, and then we conclude we are in a new economic regime where inflation goes up and we have a recession at our hands.
The so for the 10-year yields, are you saying they're gonna, or the Fed fund rate, you think it's going back to zero, is flatline? Is that your target?
I can't remember really my targets there on the different ones, but I'm saying yes, we're gonna get all-time lows on rates. Yeah, retest double test of the bottom that we've seen. Yes, because the recession we're gonna see now is going to get much worse than we haven't had a real recession ever since 2008, 8 and 9. We had a very short one when we had Corona, but they just poured everything into it. But the recession we're going to see this time around, and as you were also talking about there, Kevin, that we have so much money, so much liabilities out there, and when that starts to turn south, you're going to see that there a whole new ball game in terms of what they need to do to push it all into gear again. So I think we got to look at the deterioration in the leading indicators and say, okay, this is bad. What we're going to see here is bad. And especially also some of the charts that I got for emerging markets and the likes, which is based on Elliott waves, tells me that the decline we're going to see in emerging markets and in copper and other things is going to be worse than what we saw during the financial crisis. And that will pull down the rates as well.
My leading indicators often is just the actual price chart, let's say, of silver and oil, in the sense, like maybe not in the 70s, but at least since the 2000s, silver has always bottomed in the abyss of a recession. And often we know recessions, they backfill them. Oh, there was a recession, but like, I don't know, the 2008 recession, it started, I think, in 2007, and then they backfilled it. So what I'm looking at is if ever the silver chart does break out, and that means like whatever it's going down now and went back up, I'm pretty sure in hindsight, people are going to say that was a recession we were in. But right now they're still going down. Oil is still going down. So oil, if ever we see oil break out, then for me, it's like it removes a lot of doubt. For me, that's going to be the bottom will be in that for that wave of recession. If ever oil decides to go up, now it's going down. I think I saw one of your charts that could go even more down, but that's why I like looking just at the price chart. For me now, oil is in a sleep mode, so it broke down, I think, below 12-month average. It's going down. It's trying to find a bottom. So I'm just waiting for oil. I'm patient. I'm just waiting for oil to turn back up, and if and when it does, then for me that's a huge leading indicator that a lot of the worries are behind us. But until it does bottom and turn up, it could be skittish indeed.
But we are right now, in my world, we are in this, where the leading and the coincident and the lagging indicators exist. And there is actually a very, very bulletproof model where every time for 120 years, backtesting it, when leading indicators on a quarterly basis has been going into negative, it has led to a recession. And every time in 120 years, we have seen that the leading indicators have pulled the coincident indicators and the lagging indicators into the negative areas as well. So if we are there where I'm saying, and this is why I probably have, I've seen, yes, it's going to get bad, but we're not there yet because the coincident and resiliency of the labor market. I wouldn't touch oil at this point, because if I'm right, then you're going to see the leading indicator pulling, GDP and employment and the likes down with it. And that will mean oil will go down as well. The oil to me is more of a coincident indicator telling us this is where the economy is at right now, because it's being bought and sold rather quickly in terms of where it needs to be used. It's not month ahead. It's not like a building permit, which takes
That's right.
I need the building permit before I can start building the house a few months down the road. So that's why oil is more of a coincident indicator, and to me, oil is going to plummet below $10.
I saw that. It's crazy. Look, can you pull up that chart? Because that chart, we have to talk about your oil chart. It's something to behold.
Sure. So let me just find it here. Yeah. Then. So let me see.
And while you set that up, the question that I'm gonna ask is, at what level? Let's say oil at what level does it invalidate your theory? Look, we're not going to go down to 10. So let's say oil closes on a quarterly close above 100. Maybe it does that in next year or something, and we never reach 10. Like, is there a scenario where it's okay? Well, maybe we're not going back to 10 anymore, or your low water mark is going to be higher.
Yeah, I
like
always
at what
get
level
this. I
does
always
this,
get this question, and then I have
yeah.
to ask a few months later on and say, you know, you remember? Yeah, of course. If it goes above the B wave here, then yes, okay, then we are on. Let's just put it like that. Very simple. But for me right now, I mean, look at the technical of this. So you have a spike here into a wave 5, then you have what I think is an A wave and a B wave. And now we're getting down to a C wave. And I think we're going to see the retest of this bottom that we have all the way back from 86 here before we get into a new. And if you think about it, what's happening right now, and this is actually back to my to this also, let me just see if I can find that chart here. Hang on, there we go. What's happening right now is that we've seen the inflation pendulum getting swung all the way out here to the right side by a misalignment, no, by, let's call it a mistreatment of the corona crisis. It was treated as a demand crisis by central banks and by administrations around the world. Huge mistake. So they went out and they stimulated the market with something that is 10 times bigger than what the Marshall Aid was back after the Second World War, where you had to rebuild whole of Europe. In a supply crisis where supply chains were broken down because of corona, people couldn't go to work. I mean, it's basic economics to say this is going to create inflation. But what happens is inflation is a little lacking because it comes later. First, people will sell what you have in the shop, and then it comes what you have in the storage, and then then you need to produce the new things, and then inflation starts to pick up. That's why it's sticky by itself. It's a lagging indicator. That's back to the other chart of, which one of the lagging ones. It's a lagging indicator, and that's why it lags together with rates. But what we're seeing right now is that inflation is pendulum, or the momentum is coming down really, really fast here now. And you're seeing it come out of, a lot of areas, a lot of, like if you look at lumber, if you look at, the likes, it has really been, coming down strongly, natural gas and so on. So we are seeing inflation, coming down. But again, we have to understand that the effects that we're going to see in CPI numbers is going to be a little further down the road. But this is the reality, the economic reality. And now the problem will be now to stop this pendulum when it starts to swing in the opposite direction. Because now you will have that the things are getting cheaper, and every company around the world have been building capacity because they said, okay, we do so well after Corona crisis, we must do something right. Hence, we have to build, invest in new whatever it is. Everybody was building capacity, and that's why employment is so low, because people were being hired in. So for now, we are still in that environment where inflation is a little too hot, but the momentum is going in this direction. And I say we're going to get out all the way out here. As bad as this was in terms of inflation, we're going to see that as bad in deflation before this ends. That's how I see it.
All right. Okay. Let's say I would ask you the probabilities of gold, of oil, because this is the people they want to know. Like, I know no oil right now, it's a no touch until it either breaks down or breaks out or breaks down. But from a probabilities way, that to reach that $10 target, are we in your mind with your weight of evidence, are we at 80% chance that we're hitting that $10 before we break out above what was it, like 120 or 130?
I don't use probabilities like that. What I do is that I compare what I see with copper, where I have a chart that tells me that we're going to see very low prices on copper. What I see on lumber, what I see on all commodities I can find. I mean, every commodity has had this spike, which is to me in an Elliott wave perspective a B wave, and now we're going to see that decline in the C wave. And when I look at all of this and I see oil has had the exact same structure, then I tell myself and say, okay, is it because oil will move differently from all of the rest of them, or is it because there is a bigger picture to this? And the bigger picture to this, from my perspective, is we have had a crisis that was mishandled, which created that inflation spike because of supply and demand. Now the whole economy was set up then for inflation. All of a sudden, when it moves back down, it will be set up for deflation. And that's why I say We have to prepare for that, and that's why oil will follow down that path instead.
Jesus, man, that $10 is just, we just had negative there back in March of 2020, and going back down to 10 is just like, it's hard. Nobody's talking about $10 oil except you, I think. There.
But I said it in 2019. Nobody was talking about $10 in 2019 when I said it. Yeah. And it's in the tweets, so we can go back and take a look. I said 20 and below, probably down to below $10, and we hit the negative. I never saw the negative, but that was because of the structures. But the deflationary bust is coming. I mean, we have a recession coming. Our, the yield inverses tells us that we have a recession coming. My leading indicator model tells me we have a recession coming. So the Titanic has hit the iceberg. The thing is only we are now in this phase where there's still music on the deck, and everybody's celebrating. And then people start to say, yeah, but we have this, and now this time is different because there is a misunderstanding of the leading, lagging, and coincident indicators. And the thing is really that as long as the rates are not coming down, you can actually take a look at the rates also. If you just look at it, according to that, we are in Q1 of 2007 right now.
Yes, from what we've noticed there is once the SPX has started breaking down, let's say versus PPI, when the cuts happen, it actually, the markets, they just tumble once the cuts happen. Once, not in a bull market, cuts, they actually help. But because the SPX is below the 20-year moving average, and because a whole bunch of stuff, like the evidence is starting to show that they want to roll over, when people hoping for a cut for the markets to go up, when we get the cut,
that's the cut, and that's why the people also. I mean, I'm not a fan of the Fed. I'm definitely not a fan of whatever was happening after the Corona, because during the Corona crisis, I think that was really, really badly handled. But in terms of understanding where the economy is at this point here, I mean, they have been right in raising rates. And what we also need to see is that actually the economy usually do well while they raise rates, and you also see that the stock market normally do that, and they do it's because simply, and it's not just about liquidity or all of it, but it is about that the economy is actually producing jobs and it's actually doing well, and we see that now we have such a low unemployment. Are we coming to an end of it? Yes, we are. We are coming late cycle here. As I said, we are in Q1 of 2007, so to speak, in that analogy. And we are going to see that a recession will set in, but in 2007, it set in December of 2007. A new top in the stock market was in October. And if you look across Europe, you have new tops coming across Europe in equities. It would be very, very difficult for me to understand why would it be that the S&P topped in January of 2022 and the stock market in the UK tops in, that was actually here in January, February of 2023. So more than 1 year later, and you have the same coming now for the DAX and for others. So what I see is that we are actually coming out of the inflationary period, which has kept the consumers at bay, or keep them depressed. Now inflation has topped, and as I showed, the gasoline and prices have been coming down. Consumers start to come in again, and that's why we also see consumer sentiments, just move up a bit again. This will only be a bounce, and this will be like, oh wow, the Fed has saved us again. They have saved us. They killed inflation. That's what we start to hear, and they have managed to do a soft landing. That's what I think we will hear more and more now, and then we actually see that two quarters from now it's going to happen. Because the deterioration of the economy is like a supertanker like Titanic, who has hit the iceberg, and it's much, much more fundamental. It is that I have to pay 3 times the rent on, a mortgage loan than I had to do, 1 year ago. And that hurts my ability to consume. And that's the big supertanker thing, right?
I'm looking, I did a chart. It was when initial claims break out, that's when the Fed reacts, and they're going to probably start cutting. That's like, I don't know. It's so weird that you mentioned initial claims, because out of all the indicators I was looking at, initial claims seems to be the one that wakes up the Fed, and they start cutting there when it breaks out. So when we get a number, I don't know, 300,000-400,000, when that starts happening, it shoots up. And when initial claims are through the roof, when people think it's the end of the world, that's when the markets put the bottom in, and then they start rallying upwards. So right now we're closer to a top. Okay, I almost forgot. So if we're going up nominally, just let's say, are we going to do, is the U.S. equities going to go above its highs it did Well, when did they do the highs in 2021 or 20? Like, are we going
Yeah,
above
20
those highs?
Yeah, S&P topped in January of 22, and the Nasdaq topped in November of 21.
Yeah,
So yes, absolutely, because we
above
have to
those.
consider. Yes, absolutely. I mean, it's not. And if we said that, a few months ago about the European indices, we would say, oh wow, that's a lot.
Yeah.
And if you look at it since October, DAX and the FTSE is up like 30%.
But okay, but how much higher above its all-time highs for the SPX? Because sometimes people think, oh, it's going to double its all-time highs, but or it's just going to be a marginal new high. People think it's a breakout, and then that's when we get the rug pull.
See, that's where people that kind of like, yeah, but it cannot really be that we can move that much higher, because it must be that it just moves it just a little above the former top. I say, I base it on Fibonacci extensions, and Fibonacci extension for a long range of markets, and what I see is that we're going to get to 5,700 or maybe even 6,300 on the S&P before we reach that top. And we will see that the market is going to play catch up with the European market. We've already seen also the Hang Seng, for instance, move up quite strongly in Asia. And we have seen that as the economy starts to bounce. There are some nice, looking numbers from the PMIs also coming out from the US. So this about actually my story about this, or the theory about this, is that consumers are not as depressed anymore, because the inflation topped in June of last year. And then you've had 6 months now to start to see, okay, things are not that bad actually. And they will then come a little into the market again. And it'll just be, from now on and later into the later this year, that they're going to feel, okay, there are some other consequences of this, the inflation spike that we have had. So I think, we got time before the recession. And right now, if you see it, people say, okay, where does the liquidity come from? Because the Fed is, they are doing tightening. So, how can you have that? But there are more central banks in the world than the Fed, and the Fed is only the same size as like the ECB. And right now, Japan and China are printing like there's no tomorrow. So on last Friday, they were they purchased for was it 100 billion US dollars, just in one day. It was the largest, ever purchase in one day from the People's Bank of China. And of course that has an effect. I mean, it's money, just like it's money coming out of the Fed. And also, if you see that the Bank of Japan is doing, a lot of purchases these days as well, liquidity is coming back into the market. And I think this is where people forget also that we have had a contraction in liquidity. But liquidity is also like a pumping heart, and it comes in and goes out, and nobody wants their economies to crash. So China right now are trying to pump up their economy again. I can tell you they are, and with vengeance. It's they are running high speed here at this point in terms of getting liquidity in. And I think the Fed, the moment they pause, that will be the moment where the market really takes off, and that pause can last actually for quite good amount of time. And what I'm looking for is that major spike where everybody starts to believe, oh God, I'm out of the market. The Fed has they have saved us from inflation. Stock market started to come up. Crypto is up. I need to get in. So it'd be very much driven on FOMO and people that wants to buy in on something that they believe has been the bottom in the market.
Yeah, man. Hey, Henrik, I think this was that was fun. I know that we could have went more chart geek there and dive in more into that stuff, but maybe
Sure.
we could keep that for another time there. But yeah, this was fascinating, man. I really appreciate you coming on our show there. It was really
Absolutely.
fun. Do you want to tell folks where they could reach out there and find all your work?
Yeah, sure. So first of all, on my on Twitter, on at Henrik Zeberg, and take care. There are a lot of people that are trying to copy my page or my profile and my account. So please be careful on who you follow. And also we do the Zeberg report, which is a weekly report we do where I kind of explain where I see the macroeconomic environment is heading, and also about stocks and commodities and precious metal and so on, and then try to pull it all together and paint up that picture. So that's also where to find me.
Well, I'll keep checking your stuff out there, and if ever I'll try to comment on your tweets there if ever something I find interesting. But yeah, really appreciate your time. Kevin's back. I think you had internet troubles, Kevin. You disappeared on us.
I just completely disappeared. The internet went off entirely. So
All right.
sorry about that.
Oh, wow.
I'll watch the recording along with everybody else.
Okay. All right. Thanks again, Henrik, man. Appreciate your time. Really valuable. Thank you.
Thank you very much, Dan. Good.
All right.
Cheers.
Bye.
Bye-bye.
Bye, guys.